Let's quickly have a look at quick careers. During the poor rand, the increasing petrol price, the increased repo rate and e-tolls, Quick Couriers expected that it might incur loss in the next financial year. The owner of Quick Couriers therefore requested his financial manager to create a provision in the current financial year for the possible loss that might be incurred in the next financial year as a result of increased costs. His reasoning is that the entry will assist in absorbing the impact on the profit of the next financial year. The entry that will thus have to be made is debit sundry expenses and credit provision for increased costs, which will be a liability. Now, obviously, that one will be an expense. Now, discuss with reference to the conceptual framework what the financial manager's reply and explanation thereof should be to the owner. Your answer should include the definition, discuss the complete definition of the applicable element. So is it an asset, liability? And I already told you it's a liability and an expense, so it's a liability that we're talking about, as well as the qualitative characteristics of financial reporting. So it is a dual type of question. The 7.5 is the number of marks that the question counts. The discussion of the definition should only address the element relating to the financial position. So it's only about the liability, it's not about the expense. Financial position, liability, assets, and equity. Now, just think a little bit. What has happened here? Quick Couriers had made quite a nice profit for the current financial year. Legit. Nothing wrong with that. The owner comes and says, listen, we are going to have and going to battle next year to make the same amount of profit or even more profit. Because there's a lot of things that's going to count against us in the next financial year. Let's go and let's put a little bit of our profits of this year in the cupboard, which we are going to take out of the cupboard next year. We made the profits. There's nothing wrong with the profits that we made. There was no foul play, anything funny, no corruption, no nothing. We legitimately made the profits. So, is it so wrong to take some of our profits and defer it to a next financial period? Now, the first thing is that we have to discuss what has happened now. If you make a profit, where does the profit lie? In the income statement. And the income or revenue has a credit balance. So if you want to take out the profit out of the income statement, you have to debit the income. Therefore, I have to credit something. Now, I cannot credit another income statement account because then I haven't achieved anything. So I'm going to credit a statement of financial position account, which in this case is my provision for increased cost, which is a liability. So where are we going to start with our discussion? We are going to start with what is the definition of a liability. Now, if you look at the definition of a liability, then we say that it's a present obligation to transfer an economic resource resulting from a past event. Now, let's look at it one by one. A present obligation, we said, it must be a future expense. What is, we don't have any choices. We have to commit paying that expense. Now, usually, when does that happen? That happens if there's a contract in place, or if there's an arrangement in place, or if I have entered into some kind of transaction where I have to perform on that arrangement, agreement, contract, whatever, in the future. And I cannot get out of that obligation, so I am committed, I have to honor the obligation. Now, in this case, was there such an obligation? And the answer is no. There is no legal or constructive obligation to settle any probable future expenses in the current financial year, as none of these expenses have been incurred. Remember, why does he actually create a provision? For possible costs that he's going to incur in the future in the next financial year. So future expenses has not brought about any commitments as yet. There's nothing on the table. So it is a gut feel that he has that he's not going to perform very well next year. So therefore, there is no commitments that he cannot get out of. Good. The second one is to transfer an economic resource. Well, because there's no commitments, there's no arrangements, there's no agreements in place. So what must he transfer? So there's not a past event, there's no actual transactions, so there cannot be a decline or a transfer of economic resource that can take place. Also, there are no past events because the actual transactions, the actual incurrence of higher costs is going to happen still in the future. So basically what we could say is that provision that he wants to create, this one, provision for increased costs, well, none of the definition criteria of a liability is being met by creating that liability in our books. And therefore, we cannot recognize that as a liability. So we cannot pass that entry, we cannot create that entry. Now, furthermore, they also ask us in the question, and they tell us that you have to talk about the qualitative characteristics of financial reporting. Now, there we know that it's all about faithfully representation of financial information. And for that to take place, it means that our financial presentation, our financial statements has to be complete, neutral, free from error. Now, should we pass that entry, will our financial statements be faithfully represented? So we say that if the expense is recognized in the current financial year and therefore not in the next financial year, then financial statements for the next financial year would not be complete. So what they say there is, he's expecting a lot of future costs, which is going to reduce his profitability. Now, what he's done with his accounting entry is he debited an expense account in this year. So he created more expenses in the current year. So basically what we say is we've recognized an expense in the current financial year, which he thinks is going to incur in the next financial year. So therefore, the next financial year is not going to show all the expenses that it should. And this financial year is going to show more than the expenses that it should be. So the next financial year would not be complete, but the current financial year is not going to be neutral, nor is it going to be free from error. Now, the owner is biased if he wants to decrease his profit this year and defer these profits to next year. Why? Because he's smoothing out his profits situation over 2 years. So he wants to decrease the loss from the next financial year by lowering the profit from the current financial year. So basically what he does is he's manipulating his profits. So it's definitely, his financial statements is not a neutral depiction of the actual situation that took place. Now, if he's going to recognize cost in the current year which he didn't incur, what is he going to do? He's going to make his cost figure is not going to be correct. So there will be an error in his financial statements. Not only that is he's going to inflate his costs, but he's also going to create an obligation, which is a fictional obligation, does not really exist, by creating a liability in his statement of financial position. So therefore, his financial statements in both the income statement as well as the statement of financial position, none of them will be free from error. And for that reason, the financial manager cannot pass that entry as requested.